Okay, so thanks everyone for joining. I see that the room is packed of people, so yeah. So yeah, thanks a lot for joining. We will first do like a quick introduction round, so not sure who wants to go first. Maybe Cesar from Premia?
Cool. I'm Caesar from Premia. I run BD for Premia. The quick overview, Premia, we do on-chain options. We started about almost 3 years ago now. The original V1 was peer-to-peer options trading. It was okay at best. And so then we moved to V2, which was much more robust. We went from peer-to-peer to AMM model, which was really big for retail and also pro-tail. And then now we just launched Premia Blue, which is our newest version that has a mix for retail with AMM still. Then you have stuff for institution like RFQ Network, order books, and that's where we're trying to really drive, traffic volume, etc. So yeah, that's Premia.
Awesome. Do you want to go next, Jeremy?
Yeah, hi everyone. So my name is Jeremy. I'm a director of institutional sales at Paradigm. For those of you who don't know what Paradigm is, we're essentially a block trading platform that helps institutions finding liquidity, like deep liquidity on crypto derivatives. We have mostly been operating in CeFi, but most recently we made some pretty big moves into DeFi as well. So we incubated Paradex, which is actually a stocknet-based perps trading, a decentralized exchange that basically launched last week.
Hello, hi. My name is Dan, and one of the co-founders of Rysk Finance. So Rysk Finance is a decentralized options protocol, so same vertical as Premia. Basically, we have one product that is called Dynamic Hedging Vault, and the way it's working is we have one side that is more like passive user that deposit liquidity with expectation of returns, and on the other side we have traders, and they can trade options, and the counterparty is actually this set of smart contracts or the vault that we set, and people can trade different strikes, expiries, but always options. And yeah, that's pretty much it.
Hey, so I'm Simon. I am the CEO and co-founder of Volts Labs. I think I break the trend. Volts protocol is not an options protocol. Instead, it's actually an interest rate swap exchange. And just to add some numbers, the protocol launched on the 1st of June last year. There's been about 30 billion of notional traded on the protocol since kind of that date. There's actually around 30% week-on-week growth through the course of last year, which is pretty incredible. And to put that in context, earlier this year, Volts protocol was the 3rd biggest exchange in the whole of DeFi. So second only to Uniswap and DYDX, which just gives you a sense of the adoption of that instrument. We're also kind of launching a new product under the Volts umbrella. It's going to be called Raya. And essentially what that does is it takes a margin engine, makes that generalizable so that any derivative exchange can plug into it. And at that point, it effectively becomes a liquidity hub for all those derivative exchanges. And kind of just to continue with that point a little bit, obviously there are a lot of DEXs. There's a limited supply of liquidity. What this product does is it helps kind of essentially make the whole space more capital efficient in order for kind of teams to build and keep growing their exchanges.
Let's use just one. I mean, we are not that much to have free microphones. So I'm Alberto. Hi, everyone. Co-founder of Smilee Finance. Smilee Finance is not that far away from what they presented so far. Actually, it's providing DEX-like liquidity. So it's like you provide liquidity like you're on a DEX, but instead of being compensated by the swaps fees and the volumes that are in that specific DEX, you are compensated for the volatility risk that you have. So actually, it's like linking the risk that you have when you are a liquidity provider and the payoff that you have as being a liquidity provider. And this will allow us, on the other side, to create the so-called impermanent gain. It actually is the exact opposite payoff of impermanent loss that every liquidity provider suffers as of today. So this impermanent gain in the end is some kind of like a portfolio of option and will allow you to hedge your impermanent loss risk or to have a native on-chain like solution for being long volatility. So it's like in the middle between like DEXs and options. So in this way we can like support, let me say, the entire ecosystem to have like some new unbound of liquidity and to support liquidity providers on the other side to have a good compensation and a fair APY for the risk that they are taking while providing liquidity.
All right, thanks everyone for providing a quick intro on yourselves. It's really amazing to have such a lineup today. So for the first question that I want to ask you guys today is, could you describe the key distinctions between retail and institutional order flow, and how do these differences impact your execution? Do you want to go first? Smilee?
Yeah, I will go first, like very quickly, and then I will leave the floor, like also to the others. So in my point of view, I want to give like more the retail overview about it. I mean, what I think is options have been like, since they have been like created like a few decades ago in the TradFi market, the best solution for institutional players and proficient traders to hedge their exposure or have like some kind of sophisticated payoff while trading. This concept of option like is very difficult to explain and to make like retailers understanding, but thanks to, let me say, the Robin Hood effect, let me say, that during the COVID open up the option market for retailers, give us, let me say, a new view on what is an option. Actually, for our retailers, it's not just an hedging opportunity. For a retailer, it can be also a way to bet on, let me say, volatility, or bet using the implied leverage of the options. Actually, it's like more speculative than trading like a future with leverage. So this is like what I do believe is the way that we should all together like educate the ecosystem to use option, not only like for speculating, but also for hedging the position. It's not that easy in the end, because they are very opposite, let me say, way of thinking about like a retailers and institution on this side. But for sure, on chain, you have like a challenge that is even more difficult compared to TradFi, because TradFi derivatives market is going like smoothly. It's the biggest market, biggest than the spot market and the bond market. That's because you have like lots of sophisticated players playing it. While on-chain and basically in the entire crypto world, the traders are not just like institutional and sophisticated players. There's a bunch of like crypto traders that started like since the beginning, so they know very well the mechanics of the crypto world, but they are not super familiar with like TradFi concept about like what is volatility, what is an option, how can I use it, and why I need to use it. So this dichotomy is like something that I suppose that we need to solve all together to bring like a good amount of liquidity into the ecosystem.
Thanks, Alberto. Does anyone want to take on?
I can ask something real quick. I think it's important to actually understand what we mean for institutional when it comes to crypto, because my view when I think about institutionals, it's pensions, like pensions funds or Bank of America type of institutions, and the thing when it comes to especially decentralized finance, DeFi, we don't have those actors yet. So my view of institutionals is more probably like professionals that we're talking about, more like crypto native funds or people that are professional when it comes to trading, but I think they're not like institutional in the real sense of the word, traditional finance sense of the word. And what I see, for example, from Rysk, like those more advanced or professionals, they interact with the technology just in a completely different way, right? They use way more like API, they use like automations, they use bot, they're like not the user coming to a front end and trade most of the time. And so even the need sometimes are not, are hard for them. Like now we're talking about layer 2s and new chains, they are fast and cheaper, like but a year ago, like a year and a half ago, those actors couldn't even like build infrastructure because the chain was too slow and too expensive. So I think we are completely building all these new services for what we call like institutional in the space. But in the traditional sense of institutionals, I think they are, at least when it comes to decentralized finance, they're not even close to use it yet. But I let Paradigm probably have a different view.
No, I mean, I agree with that. It's like there is a definition, right, for institutions in crypto. So it depends on, I guess, how sophisticated is the player that is trading on your platform, right? I think when it comes to the difference between institutions and retails, right, it's like retails will use whatever, if it's option, delta one, they will have some sort of like basic strategies, right? So maybe they will look at expressing like strong directional views through leverage perps, or they will like generate yields through basic option strategies. But institutions, they will have much more sophisticated strategies, right? Complex strategies. So institutions, like those kind of players, professional, however you want to call them, those guys, they will, I don't know, maybe like have some activity managed long-short strategies on Delta One, have some pure like volatility arbitrage strategies across maturities, across strikes, across all the vol curve, basically. And that's a major difference, right? Because for those complex strategies, the level of entry into the trade, or like the execution level, is very, very important in if you're going to make money or you're going to lose money on the trade, right? And the consequence of that is that institutions pay way more attention to how tight are the spreads and to the level of liquidity that is available for them to deploy the strategies. So I think the order flow is fundamentally different. And maybe the second thing as well is that, you know, like those type of sophisticated players, they will usually try to or aim to trade like electronically, right, via API connection. And that's what people tend to forget, that maybe 99% of the trading is not happening on the UI, is not happening on the interface, is happening via API. On the other hand, retails, they come on the UI, they come on the interface, they click, they do manual trades. So that completely, I guess, changed the logic behind the way of trading.
Yeah, just to add to this, I guess one of the challenges just being on chain is that you actually don't know whether someone is retail or institution, just by nature of the fact that it's permissionless. So the only way that you can actually tell is based on the behavior of those different traders. And I guess just very broad brush, for the most part, what we've observed on Vaults is that retail just typically has got more of an incentive to try and speculate. Institutions typically have got more of an incentive to do something more sophisticated and perhaps use a derivative to hedge. And that sort of, for the most part, actually helps kind of create the marketplace that is existing on chain, where you have these different user groups that have got different needs. But for the reality is that actually, for the most part, you can't tell whether someone is retail or someone is institutional because of the nature of it being permissionless.
I was actually going to you guys answered that very well. A lot of the things we're struggling with or dealing with are deciding which direction to go for more retail, for more what crypto institution is. And right now it's kind of fun because we'll be able to see, when you say you don't know the user because it's on chain, you're not able to see like exactly who they are. When you're starting to build products that are more specialized towards a direction, so more retail or sort of more like RFQ and order books, API stuff is all like complex or more institutional direction, you kind of can segment, and that's what we're trying to do at Premia, at least, to see where we need to keep building. That's the biggest thing right now. It's like retail allowed us to get to this point for us. Is now, is it going to be institution or going to be sophisticated traders that are going to make us go to the next step? And most likely, we think that's true. That's what I think. That's what a lot of our team thinks. But where are they at? Because it's been very tough, personally, for me to get more people to come into the space at this moment right now. It's bear market, whatever. But the question is, are the products good enough? Can we keep doing that? Because their flows are very, very different. You can't keep pushing yourself one way or the other for us. So, yeah.
Yeah, also, I'm not sure if anyone has anything else to add, otherwise I will move to the next question. I mean, it builds on something that you have been mentioned, is that given that generally the sophistication gap between institutions and retail traders, do you believe that there's like a rationale for offering protection, even if it's only to some degree, to retail traders? Like, for example, protect them against like being front run, MEV, arbitrage, or those things? Or is it like a free market and the chain of the food? You want to go first, Cesar?
Yes, it'd be really helpful to do these things. Is it easy to do these things? No. Arbitrage is the one that I always think about. The reason I got into options was I got destroyed by the Ribbon Finance theta vaults. And so, absolutely destroyed. And so I wanted to build more like user-friendly or products that were able to like have principal protection. Was able to do a few of those things, but those are really hard to maintain. And also, not everyone, as we've talked about retail, most retail wants to go directionally long something or directionally short something with leverage. And so no one actually wants those things for the most part. That's the tough part for users. I don't do a lot of work on the MEV and other things, but I really want to find ways to make it an interesting yield for users to have arbitrage / principal protection. That's the kind of stuff I think is really important to them. So,
well, maybe just to answer the question. So there's as well. Sorry, there's I guess the other way of phrasing that is, should derivative trading in DeFi be regulated or not? Because you're kind of asking, should there be protections for retail users? And the question really then is, well, who's defining those protections? And I guess that is kind of a question which is debated quite a lot, I guess, throughout the whole industry. It's pretty complicated because inherently permissionless infrastructure is global on day one. That means that there are regulations in every part of the world, which, and regulators in every part of the world that would want to apply some sort of protection for their users. From our perspective, kind of what we care about is we care about building permissionless infrastructure that makes these products available to people in kind of various parts of the world if they want to kind of interact with them. That is obviously their decision to do so. But I guess if you start putting protections in there, then there's the inevitable question of like, who is it that's defining those protections?
Yeah, no, I agree with Simon. Like regulation it's a very important topic, and I guess there are many different levels of regulation. Like there is regulation to protect, regulation to anti-money laundering. It's like there are many different levels. As builders, we try to forget about it. We try to don't think about it. Probably it's different. But on the other side, like if we screw regulation, because I think we can do an entire couple of hours panel just on that. When it comes to what you mentioned, like in terms of like MEV or arbitrage, I think on the arbitrage side, for example, I don't see it as a bad thing necessarily. I think the arbitrage sometimes is a feature of some protocols. I don't think it's always good to see that the protocol or the product it's always arbitrageable. But I think the arbitrage is a use case. We see some of our users just doing hard between us and Premium, for example, and that's a use case. And actually, sometimes they rebalance our risk exposure better or the premium exposure better. So actually, the arbitrage in this case is a positive thing for the protocols, for the health of the protocol. I don't think that a business should be built only on arbitrage, obviously, because that's a different story. But I don't see that as a negative thing. On the MEV, layer 2, for example, they have obviously MEV as a less impact for many different tech reasons. But when we were talking about institutionals in this space that in my view are more professionals, those guys most of the time are the ones doing MEV because the amount of resources needed to actually do MEV and go there all the time and find the new alpha and like do the MEV and so on. It's like it's hard for single guy in his room doing it all the time. So most of the MEV right now are professionals and kind of like those institutional actors of the MEV in the space. So at the end of the game, they benefit, and it's a way for them to participate. But I think it should be, reduced because it's not healthy for the system. But on the MEV side, even we have a lot of new products like Flashbots and so on, and they're working on it. So one thing that I always say is like we are so early that we are finding the problems that we didn't know they exist, and we try to solve them. So especially when it comes to derivatives, it's a matter of time before we go to a position where actually, MEV is not an issue anymore. But a couple of years ago, we didn't even know the MEV existed. So that's where we are.
Yeah, maybe just quickly. I find it funny that we are wondering if retail should be protected from front running and those kind of stuff, right? I mean, like everybody should be protected from front running, I guess. But arbitrage contributes to the efficiency of the market. So that's a bit of a specific topic. But like, I don't think it's good if like miners or those guys they benefit from the knowledge they have of the pending transactions, pending orders to place their transaction on top of it and in front of it, right? I don't see how it benefits to the market. So I do see how it benefits them for sure. I don't see how it benefits the guy that got front run by the miners, or like any third party, for example, like intercepting buy or sell orders by paying higher gas fees or those kind of stuff. I definitely think we should encourage like solutions that protect market participants from those practices.
Yes, just quickly, I will do like a very bad statement. Sorry for this. But if I want to buy an option in TradeFi, what is my insurance that I'm not allowed to do that if I don't have the good knowledge to buy that? So platforms are not like opening to you if you are not like passing like tests and stuff like this. If you implement something like this in DeFi, in crypto, we are reducing the freedom. That is like, I think, one of the cornerstone piece of good stuff that we have in this ecosystem compared to TradFi. So that's why I'm a bit much scared if we like, I mean, I'm a bit scared because I do believe that is needed, regulation is needed, and at a certain point I agree with Dan when he said like arbitrageurs are needed still in the ecosystem because yes, they make profit out of that, but they also like balance the market in a certain sense. So that's why I really like them, and I think they should stay here. What about math? I mean, I don't know. For sure, like there are pros and cons. I will not get too much details into it. But sure, I do believe that some protection and some regulation should come for sure to make this like become like a real thing and more like close to the real economy. But on the other side, I really appreciate the freedom that we have in this space compared to TradFi.
Awesome, thank you. Now we'll be moving more into like the derivatives ecosystem or the derivatives space. We have seen a lot of protocols building like perpetuals, options, and other kinds of derivatives. Do you guys think this is a winner-takes-it-all market for each vertical? Will there be room for many very similar projects to survive? Like we have seen that there are like maybe 70 or even more perpetuals, 40 plus options protocols. Will they all make it into the next market? Do you want?
No.
Next question then.
Yeah, that's the unfortunate truth. Like if you look at the history of at least on-chain DeFi stuff, there's mainly like a winner takes a lot, and then there's 2 or 3 that come behind that. Right now, it's I don't know, like there's a lot of option protocols that are starting. Premium are a little bit older, but there's definitely over the next 3 to 4 years, you're going to see a lot of people fall off, which is natural for new products. The question is, what is the product that gets us going from, I think someone said it was like 1% to 2% of derivatives are done on chain right now. I might be wrong, maybe right on that, like that it's low. That's the point, it's low. What's the thing that pushes us to the next level? Bringing more people on chain with trading perps, trading options, trading any other product that's a little exotic or structured derivatives. So yeah, I don't think anyone's going to survive. A lot of people are going to survive. I hope we survive. I think we're in the right position, but I definitely think it's going to be a rough couple years for a lot of people. So yeah.
So just to add to that, it's really an interesting question because it actually is kind of specifically the problem that this new product we're launching through Vaults is actually looking to solve. So kind of what we've seen is 2 competing trends where TVL of the sector is obviously massively down. I think it was about 200 billion at its peak. It's now about 40 billion, so it's down by 5x. But then alongside that, the capabilities of the sector have kept on kind of growing. So what that's led to is it's actually led to just a ton of derivative exchanges, frankly, where that's honestly, I think it's gone from like a handful that you could count on one hand to now well over 100 different derivative exchanges. And the analogy that I use to kind of describe this is derivative trading. So 99% of that still goes through all the centralized exchanges, despite the fact that we had like the likes of FTX blowing up at the back end of last year. And for the most part, I think that's frankly, like, obviously people understand counterparty risk. They don't necessarily understand smart contract risk. So that's still one hurdle we need to overcome as a sector. But the other thing actually is that the kind of like functionality that exists on chain is just currently kind of inferior relative to what you can do with off-chain based infrastructure. But over the next 12 to 24 months, like my personal opinion is that we are really starting to solve a lot of the kind of limitations that have existed on chain, things like throughput, things like, frankly, figuring out how to build a cross-margining kind of DEX on chain so that's more capital efficient, right? Things like building in safety modules like auto deleverage, which pretty much every single centralized exchange has, and kind of no one, well, not to shill what we're doing, but we've figured out how to do that. So kind of bringing that on chain for the first time. But over the next 12 to 24 months, if you think about the fact that we're going to hit that inflection point, actually, I personally am extremely bullish on the opportunity for all of that derivative volume to move on chain and to move on to kind of exchanges that leverage blockchain-based rails kind of between now and kind of the next cycle.
Want to go first? I don't want to add so much because I'm super aligned with what Cesar said. Because I think we discussed this also during lunchtime. We're like super, like, we were agreeing each other on this. I mean, in my opinion, there are two things that I want to say. The first one is like, why crypto coming up in the market? Transparency and decentralization in a certain sense. So like going away from the control of banks. No, this is the philosophy behind like Bitcoin and crypto and so on. And we are talking about derivatives at just 1% is traded on chain. So that means that actually, in the end, the philosophy of crypto, people doesn't care at it at all in the end. Because if the just 1% is on chain, I mean, we can be like 40, we can be 5, we can be like 1, 2. I mean, I don't believe that will be just one dominating the scene in the entire on-chain space. There will be like 4, 5, 6 protocols that will control the majority of the market share. But again, I mean, the bet is not competing each other for that 1%. Is to bring at least, sorry for saying this to the sex guys, but you have 99%. If you give us 48%, we have 50-50, more or less. We have 51, we have 49. It will be better for us. It will be better also for everyone.
Awesome. I'm kind of curious to hear what Jeremy has to think about this, given he's not a DeFi protocol.
Yeah, so I was letting my friend, bring the arguments here, but no, it depends on the horizon we are looking at, right? If you think now, I think there are like definitely not enough people building in the space. I see you guys more as like from different like research laboratories than as competitors, I would say. Then I mean, if we think like 3-4 years from now, how the landscape will look like. Most likely there will be some consolidation, right? There is always consolidation happening in every sector at some point. So if the market is coming, the volumes are coming back, I do believe there will be consolidation at some point, and like some winners emerging out of that.
I think I have a different view, and I like to share for the latest. I don't think, especially derivatives, is a space where one's going to win all, especially when it comes to decentralized finance. Reason being is that's what we see usually from centralized finance, right? Like where you have one platform, but the entry barrier of that is high. Like when you wanted to start trade on one of these centralized exchange, you need to do KYC, you need to get in, like you're going to need a lot of like entry barrier. The thing about DeFi, the way I say as a user is once you have your MetaMask or Rainbow wallet with something, do you really care if you're using 2 different platforms at that point? Like you want to buy an option on Lyra or Premia or us or whatever, and you want to sell it on another platform or Smilee. Like the entry barrier is lower. I think what it matters though is the liquidity, and I agree with you guys. Like as long as we don't have liquidity in the space, yeah, we care about the fragmentation is terrible because the fragmentation now is like there are 100 users and there are 100 protocols, and we all have like small liquidity. So this is not working. But if we expect the market to actually grow to a point where the liquidity is enough, I think multiple actors in the space isn't a bad thing. It reduces the risk because potentially you can use multiple platforms. Some of them have some products and so on. And when it comes to, for example, perp, because that's what you mentioned at the beginning, like perp are, you can spin up a perp on an underlying so quickly. Like, tomorrow there's going to be a next paper, and maybe a platform is going to do a perp on the next paper with 100x leverage. And some users want to trade that, they go there, they trade it. Maybe some other decided not to. So if you have only one single actor in that space, I don't think it's actually needed. I guess that's the case when it comes to like liquidity-heavy protocol, and that's, for example, the case from something like Uniswap, right? You need huge liquidity there. So yeah, in that case, one's gonna win it all. But what we see from like decentralized exchanges and, for example, liquidity there is actually easy to migrate now, where we see more like order book type of product and so on. So I believe that, yeah, we don't need 1,000 of them, but I think like few of them competing and not necessarily having just one that's going to win all the market. And on the other side, let's think about this is crypto, and how many chains do we have? Like, that's how we are approaching the space. Like, we create a new chain every month, probably. We have like how many, 100 chains?
More chains than users.
Like, that's how we approach. Is that right, wrong? I don't know. But like, that's the approach that we have. And like, we love to have different chains. Like, something that was popular 3 years ago is not popular anymore this year, and it will not popular 3 years from now. So is that wrong or right? I don't know. I think it's just like entry barrier to actually build is so kind of easy that I don't see that as a necessarily a bad thing. That's like how we approach this industry, I guess.
Yeah, so maybe just to quickly bounce back on that. We constantly talk about liquidity, right? I mean, liquidity is not falling from the sky, though. It's like you have a market maker allocating X amount of money to that project, that protocol, that company, right, that exchange. So that amount of money is not a central bank, right? He cannot multiply that money. It's so if you look at CeFi, and maybe DeFi liquidity is different, right? But if you look at CeFi, look at the option market, you got Deribit owns 95% of the market, right? Since now almost, I guess, like 7, 8 years, there are like plenty of amazing exchanges, right? Launching options. You have like Bybit, you have Bit.com. Those guys are super innovative, right? And they are really good, and we are supporting them. And yet Deribit still owns 95% of the market. So liquidity, I mean, like once a market maker, it's a real guy behind making the connection, working on implementing the API, plugging the liquidity in the firm, right, on the exchange, on that or the book. Once he has spent 3 months doing that, right? He needs to spend another 3 months doing it on another exchange, right? So that's maybe one of the reasons. If he makes money off one exchange on one venue, it's not that easy as it seems to like plug on like maybe 20 different venues and having an amazing liquidity everywhere and having amazing flow everywhere. The reality is that liquidity is like fragmenting, like fragmented liquidity is not good and is not working in the market. So I agree with you. I mean, that is crypto, right? New chain, new protocol. That's amazing. We are innovating. We are building. That's good. But liquidity, it's like at the end of the day, there is, in my opinion, there is always a little bit of concentration. But
no, I mean, I completely agree on the liquidity side. But like on the Deribit example, how much of the volume is from you guys, Paradigms? Like half of it, right? So that's the reason. Like there is a single platform that made this life easier for them, and you bring 50% of the volume. And the thing is, because of like the regulatory aspect, the KYC, the onboarding, like the old institutional flow and so on, I get with you, like API is one thing, technology is another thing, but also the onboarding process is so different. Like once you get the regulation, once you get all the compliance that it's going to approve that a bit for you, you're going to be like, okay, that's approved and so on. Like, so to bring a new one, it's such like a huge amount of work. I think DeFi has a bit less friction to that. And again, I believe that we don't need 1,000 of them, but I think like a few of them competing, I think that's scenario that we're going to get. I don't think it's going to be a market for one that wins it all when it comes to derivatives. And as if Paradigm tomorrow decide to go to Binance instead of Deribit because I don't know what reason, you're going to bring 50% of volume to Binance. I guess that's pretty much it, right?
I just want to make sure we were recording that.
I want now to touch on something that you have said, like 99% of the volume in derivatives is happening on centralized exchanges, and I think that's mainly the reason why Bitcoin and Ether derivatives are the most traded derivatives. Do you guys think that having like long tail assets on-chain is going to be like the next thing to bring more people to trade on-chain and not so much off-chain?
I'll go first again. So long tail assets are really interesting to me. I won't call them what I call them, but things that are not on Deribits, basically. So a lot of thought and work has been put into that at Premia. We already are seeing like funds, market makers, more not so much the big guys, but more the smaller guys, wanting to have places where they can trade options for the long tail. It's something that we're taking very seriously and like actually building out the markets. The hardest part is finding the counterparties, because a lot of times you get retail to come be the counterparty for some of those funds. Is that good? Is that bad for them to take on these high risk, high reward moments where you have super sophisticated traders coming? But long tail as a like sector, I think it's going to be a very, like at least for us, a pretty large for the short term place to have liquidity coming, because you can't do anything with any of it right now. I don't know if you have like Shiba Inu coin or like Grail or like something like that, you only can do so much with that token. You only can trade it. You only can trade it on spot. I don't think there's even perps markets for a lot of those things. But that's the next phase, is just being able to have good volatility oracles, good volatility surface area for those, and be able to have like a somewhat okay market. I don't know what everyone else is seeing in that regard, but
yeah, I don't think it's about like just a long tail asset per se. I think what people are looking for in this industry is volatility. And so if the long tail asset have volatility, people are going to trade them. If they don't care about the specific asset per se. What we've seen recently, I think, is like one of this great example. Like there is no volatility from, anything pretty much in crypto right now. And what people have traded is like their friend on front tech, right? They just found a way to get some volatility. Like I'm gonna go to front tech, I'm gonna long some crypto Twitter personality, and that's how I'm gonna make some money out of it. So I think long tail assets gonna work as long as they have volatility. I think there is a big opportunity for them to be like more volatile, yes, because obviously they have their opportunity, but I think it's a matter of volatility.
do you think there's enough not volatility, but like enough interest in that, just like in general, just like market makers, pro tail, whatever it may be?
I mean, market makers are the most opportunistic, and probably there are a few in this room and they don't like what I'm saying, but like if there is an opportunity to make money, they're gonna take it. It's as simple as that. And their analysis, what Jeremy was saying, like if it takes me like 3 months to build an infrastructure, I'm gonna calculate what is the opportunity there. And most of the time for long tail asset, probably it's not that big, but for something like Pepe, at some point we saw a lot of market makers trading that, right? And so they are like opportunistic and they just want to make money and they're mercenary. That's simple as that. That's their job.
Sorry, do you want to go first? No, because I mean, I'm very fan of long tail asset. Actually, it's part of our vision to implement like volatility product for us, long tail asset. So I should say that I'm a huge fan of it. But I do believe there are still complexities for this market. First of all, is that, as Dan was saying, if there is volatility, so if there is pump and dump, like in Pepe, people is interested. Otherwise, no one care of. And when that period finish, no one care of anymore about that like long tail asset. On the other side, there is another thing. As of today, you can make huge amount of money just longing them without like leverage, for example, because they are so like volatile that you can make huge amount of money like with few bucks. But they are still linked to the ecosystem in a certain sense. They are just pumping let me say, the movement of the entire crypto space. In my opinion, they will become more important once the crypto ecosystem will be like, let me say, more mature, and you don't have any more like a correlation, this much correlation for any kind of token. Because I mean, I do not believe that there should be like strong correlation between a token that is a utility token for a crypto game instead, and that's like very strong correlation with a DeFi protocol, for example. It's just because they are crypto as of today. But I do believe that in the next future, they should like be not correlated in the end, because they are doing different things. They have different target, different users, different product. Why there should be like this much correlation? Just because we are in the crypto space. And I think this is the next move that we should like that should come in the market potentially. And then long tail asset will play a pivotal role because they will be like even more correlated for the related sector they are coming up. But they will not just follow the general trend of the crypto space. So there can be like more opportunity on doing like derivatives and more cool stuff there.
Yeah, just to add to this, from my perspective, I think you've got to start with the user's needs and then work backwards, right? And the reality is that right now, a lot of the users that exist in kind of DeFi, there's a lot of there's a lot of retail who essentially are looking for the next thing which is going to go up. And then you kind of got essentially the institutions that are, for the most part, that are trading around that. So if the long tail of assets is going to kind of play into that market dynamic, then it's inevitably going to get some form of traction just on whichever derivative exchange kind of launches those instruments. But of course, you do need people on the other side, and that's where the institutions start to become quite important. And frankly, I think this is why so many market makers actually invest into protocols, because they know then they've got the token distribution coming in. It means that they know that they can make the market by essentially shorting it at the point that the market goes live. But what we need is, we obviously need kind of the ecosystem to like mature, for want of a better word, so that we actually have a much wider kind of spectrum of needs that are being served in the whole ecosystem. And at that point, you know, if you're working from the customer need first and going backwards, then actually perhaps, right, the long tail of assets stops becoming such an important thing to have live on the protocols.
Also, I'm not sure if anyone has anything else to add. Otherwise, I want to build on something that you have mentioned, Simon, is that we have to work backwards from what the users need. And in that sense, we have seen that a lot of protocols have started to offer more and more leverage. Do you see that, like, is there any limit in the sense that, okay, like, when is 10x not enough? When is 50x not enough? When is like, okay, I need 1000x to really make it because this time is really different?
Well, so my opinion on this is that the question should almost be phrased like the other way around, because you should be thinking about it from a risk perspective, right? So you have a risk model. That model produces a set of outputs that essentially defines the amount of leverage that can be safely made available in a market. Does that stop DeFi protocols from competing by trying to provide more and more leverage? At the moment, no. But frankly, I think that that's just going to lead to a whole bunch of insolvencies at points in the future, right, on those protocols. People will win big, so to speak, and there won't be enough capital on the other side because they've allowed too much leverage.
Yeah, I do agree with Simon. Like, it's all about, at the end, is the protocol taking enough risk or not? Like, I'm not against giving the opportunity to the user as long as the protocol is not, you know, in the insolvency risk. If the user wants 1000x leverage and the protocol is safe with it, I guess it's all right. The real question, though, is like, why users want that and why they're looking into crypto for that. And I guess it's probably one of the main discussion we can have about the space today. It's like, I guess I know pretty much all of you here, like in this panel, and I guess people that join the space, we join for the reasons behind crypto, like, you know, transparency, as, you know, Albi was mentioning, like all this crypto ethos, and what we ended up being is like building product to give like 1000x leverage because users couldn't find that in, you know, traditional finance, because there is no regulator in the world that will make a product with 1000x leverage available, right? And that's the reason why in traditional finance options are more popular, for example, the perp, because perps are not even tradable in most of the jurisdiction. And the only place that you can get leverage in traditional finance is options, because that's the only instrument. That's why, like in the US, they trade a lot of Robinhood options. That's their way to get leverage. So users want that, yes. And in traditional finance, they fund with options. And when it comes to crypto, they fund with 1000x leverage on a perp. The reason is, so we building basically right now those products to, you know, solve this kind of problem. There is a problem, but I think it's a different problem of what we originally wanted to build when we, or solve when we joined the crypto space. So that's, I guess, the contradictory. But again, as long as the protocol is, you know, sustainable and on a safe area, I don't see anything against this 1000x leverage. potentially. And I don't, do they offer 1000x leverage? No, right?
Well, I mean,
100
like,
is possible there.
yeah.
100 is
for example,
possible.
Infinity Pools is doing like some leverage with the LP tokens of Uniswap, so then you can
By
really
Infinity
obtain a
Pools,
lot
it's like a
of
call option.
leverage.
It's like a call option. It's like a limited leverage, but it's effectively like a long call option. Like you don't really measure like how leverage you can get, right? I guess. But yeah.
Yeah, I think, I mean, as you said, right, it's all about transparency. So, I mean, if you want to be a proper degen, then be it, right? But you need to be aware that of the risk you're taking. So, I don't know, if you want to go for like maybe 50x or like 100x leverage, maybe what would be good is that we proactively inform, you know, like of the liquidation level, right? And maybe you can even draw a number where you assess a probability, how many times you would have been liquidated over like the past maybe 30 days according to the realized volatility of the asset, right? Just to inform people how much they are likely to lose and what's the probability that they are losing in the trade, right? Then if you want to take the risk, I guess you're free to take the risk, but yeah.
Do you want to say anything, Cesar?
They've said a very good job right now. You know, the big issue is we don't really have margin, or at least portfolio margin in the space right now. So, but when we do, we'll see if we do 50 leverage. See if we do 100, 1,000, whatever. It's good right now.
All right, then for the last question they have for you is, you have already mentioned that options are like the way to get leverage in TradFi, whereas in crypto we've seen that, yeah, people do not trade options as much. People prefer perpetuals to get leverage. Do you think this trend will change in like the next cycle? Or is it just a matter of, yeah, like people want to trade only like 0DTE for crypto, but there is no 0DTE for crypto right now?
I can start very biased. I hope it will change. No, I think options are simply a different instrument from perp, and they have like a different target, a different purpose. I think what we have to work on is to make options more common product for other protocols, on-chain treasuries. I don't believe that options per se is going to be a big retail instrument. I still believe the perp is going to be stick around for a long time, and I see the reason of that. But I think options have a huge opportunity for example, DAOs or other protocols. Like at some point, options they are a very good instrument for hedging. Albi was mentioning there, like, or building advanced strategies. Like the thing about perp are very simple instruments. You just bet on directionality. You think market is going up or down. You take a perp, you decide the leverage, and that's what you trade, right? With options, you can do like way more complex strategy. You can bet on volatility. You can bet on directionality. You can make strategies that are good in very specific time right now, like low volatility environment. There are some specific strategies you can trade. So I guess they're way more advanced. And for this reason, they should have like a more advanced target. And I guess in terms of volumes, they have the potential to be big enough or like same as big as perp. I believe that. I don't think they're going to be the most common product for retail. That's the way I say it.
Yeah, so just to add to that kind of final point, again, I think it's, you've got to start with the customer and then work backwards in terms of defining what instrument's going to be the biggest by the next cycle. It depends what type of users we have in the ecosystem. And I was actually just thinking back to kind of like the leverage discussion, right, which if you actually kind of really project forwards, and certainly maybe I'm speaking personally, like why am I even kind of building in this space? Like I genuinely believe that blockchain-based financial rails actually have the potential to positively impact the lives of billions of people. I think we've got an opportunity to build a financial system that's more transparent, more robust, and actually more equitable than the one that we have today. It is very nascent, right? And what that means is that for the most part, we just have kind of a lot of very early adopters of these new rails. And those early adopters happen to have specific kind of needs, right, where they are looking, for the most part, there's a kind of a marketplace of retail that's looking to speculate, and there's institutions that are kind of trading around that. Between now and the next cycle, we need to kind of move beyond those early adopters and actually start bringing more institutions into the space, kind of diversifying the set of actors that are operating on top of these protocols. And then that starts to define like what instruments are actually going to be predominantly traded, because options are going to increase if we are able to bring in kind of more institutions into the space. If not, it's going to predominantly continue to be perps.
Yeah, totally agree. In the end, even though we are like super focused on degen, I do believe that degen at a certain point will jump in and use option as they are doing it on Robinhood in TradFi. But I really do agree that there is like a huge ecosystem now in the crypto world with DAOs, market maker, protocol on liquidity, and stuff like this, in which there is a huge amount of money. And as of today, they mitigate their risk and they protect themselves with perps. Potentially, option will be better for in terms of capital efficiency and because you are not getting liquidated. This is my let me say, my bet in the ecosystem because, you know, if you need to protect your home bag as a DAO or you as a protocol, better to have the best solution to hedge your money and to optimize your capital efficiency. Why I still do believe that retailers as of today, these have like this kind of, they get satisfied to get liquidated. You know, you bet on a perp, you go there, maximum leverage, few minutes, you're out. Oh, I'm super happy about it. You know, because it's like, oh, or I go big or go home, no, you know, like, if it got right, I like a huge amount of money. Otherwise, I get liquidated, but I'm still fine with it. I don't believe that retailers should think in this direction, to be honest. So that's why I think that altogether bringing the option into the ecosystem will be also beneficial for them in a certain sense.
I'll hop in. You know, options are great. That's why we're all here. But I actually think the approach would probably be that a lot of our platforms, or at least how we think about it, will all have some kind of perp in the background because you're going to be most likely trying to get towards a Delta One product to be able to offer margin, which is something users have asked for, portfolio margin specifically users have asked for. We haven't been able to deliver just yet, but then the next year, two years, starting to see that. So I actually think perps are going to stay around for retail, but also institutional products that are being offered. And start to look at that direction. It's not like they're obviously not going to go away, and options may become bigger, but they're needed right now for the space. They're needed for like the short term and even maybe the midterm time horizon. So I think it's going to be just a continually growth. You might not see more products, but more collaboration between perps and options platforms. So yeah.
Do you have anything else to add, Jeremy?
Yeah, so obviously our DNA is options, so we love options too, right? One thing that has not been mentioned is that the perp market cannot really disappear, right? Because, I mean, you need a Delta One market because most of the people trading options, they don't want to take a directional risk, right? I mean, retail want to take a directional risk maybe, but like institutions, they are betting on the volatility, right? Not on the movement on the underlying. So you will always have a need for a proper liquid Delta One market for like all these institutions being able to Delta hedge their position on options, right? So I believe that in the future, if the market grow, and it will grow, it will be both options and Delta One, in my opinion.
Awesome. So before opening up the floor to questions from the audience, I want to thank the five of you for being here today. It has been a pleasure being your moderator today.
Thank you.
Thank you so much.
Any question?
Question, can you explain the role of, or is there room for under-collateralized lending in DeFi derivatives?
You're asking, is there under-collateralized lending available right now in DeFi derivatives, right? No, there's not. It's not available. There's definitely room for it. We think then, hopefully, if everything goes right, we're about 6 months away from being able to do some under-collateralized or portfolio margin. I know in about, the devs say about a month, maybe longer. We're going to be doing margin on spreads. So you're going to start to see things like that coming out. So isolated margin, that type of stuff. But yeah, that's the next phase that lets you become more and more like centralized finance or centralized options exchanges with the margin you're offering. So.
Wow, I'm keen to see that for sure. Because I was about to jump in and just say no, because I think as long as it's permissionless, or so long as a protocol is permissionless, I'm keen to see it because I think anybody could just build a bot and just drain the amount of kind of leverage, capital that you're making available in the form of
I'm
lending?
not going to say I'm the person who's figuring all that out, but the risk and the amount of capital we can lend out is like the biggest reason, the biggest thing we're working on right now. So yeah. We will talk after this.
Any other question?
Thanks for the panel, guys. Like, really, really interesting. I mean, as you guys mentioned, there will definitely be the presence of both, so perps and options. Do you think, like, the ones that already have the infrastructure for perp would have an easy way to transition from perp to option when the volume kind of migrates, if it ever happens? Thank you.
I've done a lot of analysis with the team on that. I think it's way easier the other way around. If you build an option, it's way easier to integrate a perp. Options are in DeFi, and they'll also connect to the uncollateralized idea. Like, options are very complex instrument when you want to put it on chain. And the main reason is the collateralization, for example. Because you're trying to collateralize something that the value might vary like very fast and in an exponential way, because there is a convexity of how an option works. So if an option today is worth $5, in a matter of minutes, it could be worth like 4 or 5x. And I'm not kidding, like it could happen. So finding the right collateral for that is very hard. And the other thing about is like options are based on implied volatility. That's how you price them. And implied volatility is actually it's a variable that is not known and is estimated by the traders, right? So the problem is there is no oracle that is going to give you like what is the right implied volatility at that time. Like you can make an estimation or something like that. So building an options protocol, the collateral required, all the nuances of like pricing, because of the pricing of the option is a probability way of pricing them and so on, is actually more complex than building like a perp per se. So if you have a perp and you want to build options, it's probably harder than the other way around.
Okay, guys, thumbs up. So thanks everybody for and all panelists.
Thank you, guys.